You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast coming to you from Montecito, California. And today, before we begin, I want to remind you that there's a website associated with this podcast called wealthformula.com. Go check it out and consider joining some of our groups, including the Investor Club, because who doesn't want to join a club? And you can qualify for that simply by knowing whether or not you're an accredited investor. An accredited investor is somebody who makes $200,000 per year, $300,000 per year if filing jointly. And that's for 2 years with the expectation of continuing to do so in the future, and or a $1 million net worth outside of personal residence. If you are an accredited investor, there is a different world for you, and you should learn about that world, the multiverse. And go to wealthformula.com and make sure you sign up for the Investor Club. Let's talk about the show today. I'll tell you, with the presidential election coming up and all that my thoughts are never reflected completely in these elections because I describe myself as a libertarian. A libertarian, for the most part, is somebody who is a strong believer in civil liberties, meaning I don't care what you do with your own life, who you sleep with, who you whatever. I don't really care as long as it doesn't affect me. On the economic side, I believe, and as libertarians believe, in the concept of a free market. Now, libertarians will argue that a truly free market fosters prosperity and innovation and individual liberty. But that doesn't really describe the American economy, does it? Over the years, the American economy actually has become a place of increasing numbers of regulations, whether they're federal, state, local levels, and there's constantly these constrained economic freedoms. In addition, governments constantly intervene in the economy. I mean, look at corporate subsidies, bailouts, right? Bailouts, preferential treatment. We're talking about corporate welfare, ladies and gentlemen. And you don't need to look farther than the recent regional bailouts that we saw. I mean, the problem is, right? Like if you look at it from a libertarian perspective and maybe just a logical perspective, interventions like those bailouts distort incentives and motivations, and that effectively is not a free market. So, for example, we're talking about the whole bank bailout thing. Now, the regional bank bailout that happened was, it was complicated. I'm not going to say it was simple, and in many cases, they were probably not doing stuff that was terribly risky as much as they got screwed by bond prices and that kind of thing. But, even if you go back to 2008, you know that the banks have traditionally done a lot of stuff that's very risky, where if they win, they make a ton of money. And if they lose, the taxpayer flips a bill in the form of a bailout. Now, that's the question. Does a truly free market even exist? I mean, look, that's not a free market when you have bailouts like that. Bottom line is, though, that I'm not sure, even if we could do a completely free market, the ruthless nature of what that would look like, that we would truly find it appetizing anyway. However, there is no doubt in my mind that a freer market would do the economy some good. And my guest on today's Wealth Formula podcast certainly believes that. He is a member of the Libertarian think tank, the Cato Institute, and explains how government intervention has hurt us and how it will continue to do so if policies do not change. And we will have that interview after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Ryan Bourne. Ryan occupies the R. Evan Scharf Chair for the Public Understanding of Economics at the Cato Institute. He's written on numerous economic issues, including fiscal policy, inequality, minimum wages, infrastructure spending, the cost of living, and rent control. He's the author of The War on Price, How Popular Misconceptions About Inflation, Prices, and Value Create Bad Policy, and also Economics in One Virus. Ryan, welcome to the show.
Great to be with you, Buck.
First of all, just so people understand what the Cato Institute is, we've had people from the Cato Institute before, actually, but it's always a nice reminder to understand what the goal is there.
Yeah, so the Cato Institute is a libertarian think tank operating here in Washington, D.C. So the bulk of the work that we do is analysis and advocacy, not so much direct advocacy, but analysis and kind of outlining what we believe are better public policies conducive with the principles that we believe in of free and open markets, essential freedoms under the law, and peace. We do a lot of work in the economic space across a whole range of areas, from financial regulation all the way through to trade policy. My role here at Cato is slightly different. I'm more public facing in my work. So most of what I do is try to use the events that we're seeing in Washington to highlight basic economic ideas and concepts through an educational platform.
Let's talk about what's going on today, I guess. I mean, I think one of the ideas is that the market prices are under siege. Is that right?
That's right. The essence of my book, The War on Prices, is that we're kind of living through a period in which many of the things that economists took for granted about our understanding of inflation and market prices are under attack. So after inflation hit, I recognized that there were a lot of misconceptions and confusions about inflation that we thought were buried in the 1970s appeared to be returning. So you saw this idea permeate that inflation was the result of just greedy corporations, or the belief that temporary shocks to the oil and gas prices after the Ukraine war or the pandemic had led to kind of the explosion of inflation. And as a result, I think there's a large section of the population who thinks inflation is really the result of malevolent actors or one-off shocks, rather than primarily being about what I believe it was about, was a story of monetary mismanagement. So I wanted to write a book about this regression in economic thinking and how it's created space really for advocacy for damaging policies, things that I don't believe would help solve the inflation problem, but we're being advocated anyway, like the Inflation Reduction Act, extensive green subsidies, but then all the way through to things like price controls, or what we're seeing at a federal level with Joe Biden going after companies for how they structure or what they're charging for individual products. So the more I thought about it, the more I thought, actually some of these economic mistakes lying behind this analysis actually translate to some of the spread of what we're seeing of price controls in individual markets in the US. We're seeing a return of rent control, much higher minimum wages across the country. We have legacy price controls in a range of healthcare industries, anti-price gouging laws, junk fees regulation. So ultimately, I put together a collection of essays to address what I believe are three things: the misconceptions about inflation, the real economics of historic and current price controls, and then addressing some of the more moral arguments against using market prices rather than having government determine them.
How do market prices provide value to a healthy economy?
Well, the essence of where prices arise is that they're developed through voluntary transactions in the economy. So I only tend to buy something if I think I get more value from the product than the money that I'm exchanging for the product. And the same goes for the seller. The seller will only sell me a product if he or she believes that they're getting more value from obtaining that cash than giving me the product. And in essence, when you get this through the whole economy, it means that prices aren't really determined by, an individual actor deciding this is what I want the price to be because I'm being greedy or whatever. It's determined by that balance of supply and demand, the willingness of producers to provide goods and services to the market, and the willingness and ability for us as consumers to pay for them. And the way that creates value really is twofold. One, it leads to a fairly efficient allocation of resources, because when the fundamentals of supply and demand change, so suppose all of a sudden a pandemic hits and we all want to go out and buy hand sanitizer and face masks and things like that. The higher price both encourages those of us who are demanding these products to think, well, do we really need to buy as much as we would have done at the old price? This is a very scarce resource at the moment, and do I really want to pay as much for the amount that I thought I might need? But at the same time provides an incentive to the producers to produce more of the good and service. It accounts for the fact that they're going to perhaps having to be running their machines or distilleries more aggressively, the fact they're going to have to be paying some workers overtime because demand has gone up. So the price movement helps calibrate supply and demand. So that's the kind of first benefit of market prices.
So the counter to that, I guess, would be if you have price controls, you have an inefficiency there and a mismatch in all of the variables that you've just discussed. Is there an example of that you could give us?
Yeah, so the vast bulk of the book is talking through these examples. So the quintessential kind of classic example of a price control is rent control.
Right.
So rent control is an instance where government imposes a limit on, say, how much rents can increase each year. And as a result of the imposition of that price control, the rent that landlords are able to charge will be below the market rent, what the rent would otherwise have been in a free market.
Right.
And we know from extensive history that one major consequence of this is that holding rents below market rates leads to a shortage of rentable accommodation being available for people. So the quantity demanded vastly exceeds the quantity supplied. And that might be because some landlords decide it's more profitable to now sell for owner occupation, or more profitable to convert to a condo that perhaps lies outside of the rent control regime. But at the same time, of course, lots more people want rentable accommodation if the price of it is being held down. So those two factors interact to create a shortage in the market. And over time, that can compound and become more damaging, actually, because if you reduce the effective returns to providing rentable accommodation, then there's a big risk that you're also going to get less in the way of new building as well.
Got it. Let's talk a little bit about inflation. People confuse sometimes inflation for price spikes. How do they differ?
Yeah, this is one of the big things that we've heard during this pandemic, really. Quite often you'll read a news story and people will say, gas prices are high at the moment. That's driving inflation. So we have to separate out what happens when you get an individual price change for what happens when you get an overall rise in the price level through the economy, which is really what we refer to inflation. So the price of everyday goods and services can change for both supply and demand reasons at any given time. That differs from a change in the general price level, an increase of which we call inflation. So really inflation, what we mean by that is a reduction in the purchasing power of any given dollar. And that manifests itself through a proportionate increase in the long term of all prices going up in the economy. So $1, if you held $1 for a given period of time, would buy less much. And it's important to understand that difference because if you think about it logically, an individual price going up can't really cause inflation. Now, why is that? Well, suppose all of a sudden the price for, say, bananas goes up. There's a big increase in demand for bananas, but the price of bananas goes up. Well, let's suppose we live in a world where all consumers really, really like bananas and they want to carry on buying bananas. As a result of buying bananas now at a higher price, the consumers have less in the way of disposable income remaining to spend on other goods and services. So demand for other goods and services declines. And as a result of that, prices of other goods and services falls. What I'm getting at here is the only way you get into a world where all prices in the economy increasing over a period of time, that is an inflation, is if we have a fundamental imbalance between the amount of money in circulation being spent and the number of goods and services in the economy being produced. So inflation as a macroeconomic phenomenon is really just when you have too much money chasing too few goods and services. And that can be caused by the Federal Reserve pumping in too much money, so causing too much money for a number of goods and services. Or in the very short term, it can be caused by some cataclysm hitting the economy. We're producing far less than we did before, and the same amount of money is then chasing fewer goods and services.
Some of these numbers, though, do change some of the metrics by which we measure inflation in a very meaningful way. I mean, I guess the example we've been talking on this show in the last few episodes with a few folks about the impact of rent increases on the CPI, for example, which tend the numbers that tend to be used there are lagging indicators. And so presumably you would look at that and say, well, maybe it was a price spike for a period of time because, whereas when the Fed was calling inflation transitory, rent increases were 11%. And well, in real time, we're probably almost flat right now. But so those are transitory. Would those be spikes then? And if they are spikes, I mean, we're looking at them through the lens of inflation with the metrics that we use.
Yeah. So in essence, we can't observe inflation perfectly. So we try and get around that by taking a weighted average of what consumers spend their money on and looking at those prices and weighting that average basket of goods and seeing how it changes over time. Now, that's never going to be perfect because the goods that we spend on over time tend to change. And as you say, there are all sorts of peculiarities within some of these indices that mean that certain things, particularly rental accommodation actually, tends to be reflected in terms of its impact on inflation later with the lag. Right. Than most other goods and services. So I think the best way to kind of interpret what we lived through really is that we had a big monetary kind of explosion in the first 2 years of the pandemic. It takes time for that money to seep out through the economy. Actual CPI inflation that we were really experiencing probably spiked significantly higher than the underlying CPI metrics suggests. And now some of that is being shown in rent increases being higher now than the rest of the index. But actually, if you look at the big picture, we saw a big monetary expansion with the normal lags that economists would expect. Prices through the economy started going through the roof, and now inflation is still above target, but is much back closer to target as the growth in the money supply slowed and actually went into reverse for a period of time.
So when you look at central bank policy right now, I'm guessing you would suggest that it's sort of misguided. And if it is, how's that impacting market prices?
Well, the important thing to remember with I think inflation is that it reflects things that primarily reflects things that the central bank was doing a year to 18 months ago.
Right.
So the big picture, if you look at the balance of spending and production, the big picture at the moment is still, it appears to be that over a year ago, the Fed had set policy such that there was too much spending in the economy relative to its ability to produce goods and services. And so inflation is still above its 2% target. Now, I actually think looking ahead, the money supply has been weak for a long period of time. Yeah. So it could well be that in the very, very near future, inflation will actually come back to target. So I'm not calling for the Federal Reserve to drastically tighten policy now. Yeah. But I think it's just being aware that what inflation can really tell us is how appropriate Federal Reserve policy was kind of a year ago. And what we've seen really in the aftermath of the pandemic is that Federal Reserve policy has consistently underestimated so far what is needed to be done to get inflation back to target. Now, some of that, I think, they can be forgiven for. There definitely were supply shocks, we call them, that hit the economy. There were difficulties coming out of the pandemic and with the gas price spike during the Ukraine war. And it would have been silly to tighten policy drastically to account for those factors that undoubtedly for a period of time drove up prices. But beyond that, it's pretty clear now when you look at trends in total spending on final goods and services across the economy, what we describe as nominal GDP, that has run way above target. Way above the trend prior to the pandemic since really late 2021. And it's still the case that that's growing more quickly than we were used to and more quickly than is conducive with hitting that 2% inflation target.
Although you did mention that what you were seeing suggested we might be getting down to targets quicker than expected, maybe by most. And could you elaborate on that a little bit?
Sure. Yeah. Well, I think in the medium term, I think the key driver of inflation, the price level, is really the money supply. Now, the Fed can't, we know from the 1980s, the Fed can't perfectly target the money supply. So I'm not saying this should be a Federal Reserve target.
Right.
But when you look at what's happened over the past few years, there's really a story of the money supply growth going through the roof, and then the money supply growth falling off quite quickly. And I still think we're in a period where the price level is adjusting to things that happened in the money supply a year to 18 months ago.
And there's quite a bit of tightening going on right now still, right? I mean, quantitative tightening.
So the money supply was actually negative for most of last year, money supply growth, that is. So the money supply was actually shrinking. So one would imagine that if historic relationships maintain, then in the next 6 to 12 months, we may even be talking about below target inflation or deflation as a result of those monetary trends. But so it's always important to bear in mind that there's a lag between what the Federal Reserve is doing and when that ultimately feeds through into prices. Now, there may well be one-off things that are going on at the moment. The federal government is borrowing vast amounts of money. That increases in many cases, that increases the velocity with which money circulates in the economy and is actually spent at a given time. So there might be some one-off factors that are actually keeping inflation above target. But I think it's really difficult to look at what's happened with the money supply and think that inflation's not going to continue to fall in the near future.
Yeah, and along that lines, actually, I had a gentleman by the name of Campbell Harvey on. I don't know if you know, he's an economist at Duke, who talked quite a bit about how the real-time rents were so far off, whereas the CPI was using a 6% number, and in reality, if you look at even generous projections of real-time rental increases, it's probably it might be close to 3%, 3.2, but that, we have a lot of apartments in our portfolio, and I'd say it's probably pretty flat at best. So anyway, he was talking about how if you adjust for real-time inflation, he was projecting that CPI probably in real time was really more likely close to 2.1%. And when I heard that, I couldn't help but thinking the Fed, listen, these guys they're not dumb. They probably see some of these numbers coming up, and their worst nightmare is deflation, right? So that makes me wonder what they're going to do next. I'm just curious on your take on that. I'm obviously no economist, but just putting two and two together.
Yeah, no, I think that's right. But we have to bear in mind that even though we wouldn't like it to be, and I think, the Fed does have a degree of independence, ultimately the Federal Reserve is conceived in politics.
Yeah,
and
sure.
It's certainly the case that over the past few years, they've made mistakes which have led to prices being much higher than they otherwise would have been. And so I think the Federal Reserve will be absolutely keen to make sure that inflation is back at target before it is seen to be loosening policy explicitly through doing something with the federal funds rate or any of its other metrics. It will not want to give the impression that it has gone soft on inflation, particularly because, here in Washington, D.C., there's a lot of ideas percolating for the Fed to be more expansive. There's some people that want to increase the inflation target from 2% to 3%. There are other people that have opposed all of the Fed tightening through this period and attributed all of the inflation to corporate greed or one-off supply shocks like the pandemic and the Ukraine war. So in that environment where there's a lot of pressure on the Fed to be looser, I think the Fed will now want to make absolutely sure that it gets inflation back to target before it even conceives of re-loosening policy or changing its monetary stance.
So yeah, I guess they're still trying to make up for that whole transitory inflation thing that they screwed up on.
Well, no, yeah, it was a fundamental error when you look back. Essentially, because they believed that all of the inflation was being driven by actions in individual markets. Ports being clogged, companies having difficulty reopening during the pandemic. They were talking about a period in which inflation was going to be high for a matter of months, and actually inflation's been high for well over 2 years, two and a half years. And, we have to recognize that error. And one of the errors here, I think, that I explain in the book is that when you do have an excess demand in the economy, and too much spending in the economy relative to production, it's always going to be the case that you see prices rise in some sectors faster than others. In sectors which don't have a lot of spare capacity, the first order effect before you get a general inflation is going to be prices rising more sharply in areas which do have the supply constraints. Now, the mistake they made was to think that meant that what was happening was just the supply constraints were driving inflation, when actually it was the excess demand was first showing up in those sectors before we saw the broader inflationary forces move into, a whole range of different markets, everything from, hotels through to restaurants and everything else.
What could we be missing that would actually keep inflation numbers higher than you and a number of other economists are projecting? I talked to a lot of economists on this show, and pretty much everybody's saying all these pressures, all these changes are pointing to, inflation numbers probably going down. But I guess the question is always like, what could we be missing? What's that variable that hits everybody in the head? Just like, the Fed missed it so big before.
Yeah, that's a great question. Well, I don't necessarily believe this, but if I was putting together my best case for, what we might potentially miss, it's that actually fiscal policy, government borrowing plays a much larger role in driving inflationary forces in this particular environment than it has before. So I think if you're somebody like me who looks at some of the monetary aggregates, yeah, it certainly looks like we're going to continue, things might be volatile, but we might continue on a downward trend of disinflation, the inflation rate falling. But, if you listen to some other economists like John Cochrane, who believe in the fiscal theory of the price level, one could imagine that you have a scenario in which the federal government continues to borrow vast amounts. And there's just a fundamental shift in sentiment in the belief that that's ever going to be paid back.
Right.
And if people start expecting that the federal government is not going to pay its bills and start expecting that the Fed at some stage will have to come in and help the federal government out by, suppressing its borrowing cost or directly financing government activity, then I think you could see inflation expectations go up pretty sharply. The second thing that I would just say, though, maybe we're underestimating, is a lot of people talk as if everybody has suffered greatly in the past few years through high inflation. And it's certainly the case. If you're on low income and you don't have much in the way of savings, these big unexpected price spikes, particularly in areas that you spend a lot of money on, like food and energy and the like, they can be extremely harmful. But an underexplored factor in this whole debate really is the fact that through the pandemic, actually, as a result of not spending much, people weren't really engaging in much discretionary spending. They couldn't go to restaurants. They couldn't do lots of things that they enjoyed. They weren't going on as many vacations. Household balance sheets actually built up pretty substantively. Mm-hmm. And so people had higher wealth to draw down on. And to the extent you get a large number of families, say, who are willing to spend more over a given number of years to get back to the position that they had prior to the pandemic and spend down those wealth balances, you could see stronger than expected total spending through the economy for a longer period of time than perhaps the monetary indicators might suggest.
Interesting. It's an election year. How do you think, if in any way, that affects decisions and policy? I mean, I think it probably does, and there's probably also some historical data with regard to the way, people behave during an election year. But I'm just curious if you have any thoughts on that.
Yeah, I mean, on the monetary side, I think it would make it less likely that the Fed would engage in any substantial change of its policy stance, because it wouldn't want to be perceived in helping one candidate or the other. Now, I mean, of course, as an independent institution, it kind of has to try and look through that as much as possible. But it's inevitable, really, that when you've got those political forces, I think in the back of their minds, it's always going to be a concern for them. But I do think we're seeing electoral politics play out in other areas in regards to these issues. So, since the start of last year in his State of the Union address, Joe Biden has been using every opportunity conceivable, really, to paint inflation as being at least exacerbated by greedy corporations,
Corporate greed, right?
by companies producing retail goods, kind of shrinking their product, by adding lots of junk fees, as he describes them. And, I think that's a recognition, really, of the fact that the public really do loathe a high inflationary environment. They've seen their price of their food at home expenditure, their grocery bills go up by 21% in the 3 years since Joe Biden has been president. For context, that same price index had only gone up by 18% in the previous 11 years. So, like, really dramatic increase in food prices at supermarkets and grocery stores. And this is the biggest political albatross around the president's neck, really.
Right.
And so he is trying to deflect blame for this onto corporations. Now, are people buying it? Well, actually, yeah, there's some evidence that he's getting some cut through on this. When you ask, YouGov asked the American public last July who they blamed for inflation, they gave them a whole range of options, actually excluded the Federal Reserve for some reason, so it probably tells you something about levels of understanding of these issues. Yeah. But the main group that actually the public pointed to as a source of inflation was greedy corporations. So expect far more of this from the president. And, I think that will manifest itself in a whole range of little kind of technocratic price controls, regulations on pricing structures, and everything else.
Very good. Well, listen, this has been a very interesting conversation. The book again, The War on Price, How Popular Misconceptions About Inflation, Prices, and Value Create Bad Policy. Assume it's available pretty much everywhere. You can get books, and is that right?
Yeah, it should be available. I mean, it's available on Amazon, Barnes & Noble, a whole range of other bookstores online. Yeah.
Got it. Ryan Bourne, thank you very much for being on Wealth Formula Podcast.
Thank you for having me, Buck.
We'll be right back. Welcome back to the show, everyone. Hope you enjoyed it. Just a couple things before we go. I want to remind you, join the Accredited Investor Club if you have not done so. We are going to probably in the next 6 months or so, probably really get ramped up, as I anticipate there will be some changes in the markets, making it a much more buyer-friendly market to get involved with on the real estate side. And there's certainly other things that we're doing there as well. Go to wealthformula.com to check that out. Also, a reminder that if you are on social media, Instagram, TikTok, whatever, Wealth Formula is there. And so follow us there. And if you'd like, follow me personally. It's buck.joffrey. And, I don't, it's more personal things anywhere, but that's where I actually kind of spend some time. So if you'd like to get in touch with me directly, that would be fun to do so. So anyway, that is it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.